All right. Welcome back, or welcome if you're new to MarketEdge.com, your source for unbiased technical stock research. With me today is David Blake, here to give us a tech talk on what's been going on in the market and what we should be looking for as we head into this week's market. David, how are you today?
I'm doing well, Rachel. Thank you.
Great. Let's jump right in.
Okay, well, we had another seesaw week last week. We started out with a 2-day relief rally after all the war headlines that we've seen. There's a little bit of a hope that we're going to see tankers start to go through the Strait of Hormuz. And that led to actually the NASDAQ bouncing 375 points on to start the week out. 1.7% of that was in semiconductors, I believe. And then things got bogged down when we had a hotter inflation report than what we were looking at. We had the February PPI jump 0.7% versus 0.3% estimated. So more than double what the inflation prospects that we were looking at. And then 3.4% year over year. And then on the core PPI, it was also a little bit hotter than expected. And it was up 3.9% year over year. And that's almost double what the Fed is hoping to achieve with their policy, although most people don't think that 2% is really going to be hit here. But anyway, that kind of started the day off Wednesday on a big sell-off. And then we took a second leg down after the FOMC meeting minutes came out, and Fed Chair Powell left rates unchanged, but he was a little bit more hawkish than what was actually projected. He was saying that right now he thought there was maybe a chance of only one rate cut in 2026 and maybe one in 2027. We started out this year when the market was going up with investors thinking we could see as many as 3 in 2026. And that certainly doesn't look like the case right now. And in fact, I believe in December, it's only a coin toss. I think yesterday was even the fact that there's a possibility of a rate hike was a little bit higher than a rate cut. So we'll see how that goes. Rates have ticked higher. We actually saw the 2-year and the 10-year both crack through some fairly heavy resistance levels last week. We thought about 4.33 or so would be a resistance on the 10-year Treasury, and it actually got up to around 3.93%. The 2-year got up to 3.90. I think the resistance on that was about 3.75, 3.8. So these are the highest levels we've had on rates since August 2025. And of course, we've had 3 rate cuts since that time. So President Trump banging for rate cuts is probably going to be unhappy with the path of the Federal Reserve going forward here for the next couple of months, especially with oil going up here around $100 a barrel. That's going to also add to inflation. And I don't think with inflation moving like that, you're going to be cutting rates. So anyway, as rates went up last week, we saw almost every sector was lower. I think the energy sector obviously was the strongest sector. We had new highs being hit by Chevron and Exxon Mobil, Valero Energy, Halliburton, all of them. Most of the big oil companies were making new highs. The higher rates also weighed on housing stocks. The 30-year mortgage was, I think it was like 5.9 just a couple of weeks ago, and we're all the way back up to 6.6%. The U.S. Home Construction ETF, ITB is the symbol on that. It was down 5.3% last week, and it's down 22% since it peaked in February. So the housing market is really soft again. And in fact, I believe last week mortgage applications were down 17% on the week. So buyers are stepping back until they can see what rates are going to do in here. That hurt all the housing stocks that we follow. Okay, so we go into the weekend on a 4-week losing streak where all the major averages were down below their 200-day moving average. We had Lipper came out with a report that showed that U.S. equity funds had $28.78 billion in net outflows on the week. That shows that the investors are moving to the sidelines on fears that the Iran conflict could escalate a little bit. So people that wanted to see what was going to happen over the weekend. And then sure enough, Trump doesn't like to see the market go down. He came out and said that we were in big talks with Iran, and things were moving ahead and everything was going to be great. And again, it may a matter of days possibly. And we had a heck of a rally to start the week. In fact, the Dow Jones futures were down 400 at about 8 o'clock in the morning. And then we opened up 1100, I think. So the market is ready to roll if this would ever end. But a lot of that also was short covering. A lot of people, traders especially, are looking at as the technicals in the market begin to break down. they're shorting things left and right. And then when they get a headline like that, that things could be over again, they've got to cover. And when you have a big move like that, that means that they're chasing the market higher. They don't want to be stuck if we go up 2,000 or 3,000 points. So that propelled a lot of that we saw yesterday. So anyway, after being up 1,100 points, the Dow did pull back a little bit, closed the session up about 631 points, 1.38%. S&P 500 was up 1.15%, and the NASDAQ was up 299 points, 1.38%. So that was still a nice move. We did not take out the highs from last week. In fact, we barely got up to the highs of last Thursday before we had that another sell-off. So it was nice to get a little bit of stuff. Hopefully, maybe you sold some stocks on the way up yesterday when it was up a little bit, of something that you're not quite sure of, or if you're still a little bit cautious about if you think that the Iran war is going to go on for maybe another month or two, you maybe want to lighten up when you hit these big moves off the headlines. Okay. As far as the technical condition goes, we did see more deterioration last week. We are still in a series of lower highs and lower lows, which is a very bearish pattern. We did see the S&P 500, the Dow, and the NASDAQ all close below their respective 200-day moving average. And actually, every little rally that we get off of a headline, every bounce seems to be stalling just below the prior high. So people are using these headline spurts to lighten up, which is another bearish sign. The trend indicators, including the MACD, it confirms the bearish downtrend. Momentum, several momentum indicators I look at are slow and negative. And in fact, I often talk about the 14-day RSI. If it falls below 40, that's a sign that we've seen the major trend start to roll over. If you go onto our charts over here, you'll see over here that we are below at 40. Actually, we ended up around 38, 30, 35, 30, something like that. 26 it actually hit on the S&P 500 during the week. So that is confirming that the trend has changed. Now, what you'll watch for on the upside, if we get some rallies, they should stall out on the 14-day RSI or 60 or below. That with Connie Brown, who's a technical analyst, has done a lot of work on this, where she has found that would confirm that we're still in the downtrend if a rally stalls below 60. So that's something you can watch on the charts just to see on some of these big rallies that we have off of the headlines, whether or not we're really having a big turnaround, or that's going to be it. I did notice that we still have not had what you call a washout. And that is what you would see when you see the market go down, say like 1,100 points or 1,200 points, and all of a sudden we start seeing some buying coming in, and the thing all of a sudden goes and rallies up to probably a positive finish. And that is just an oversold rally, a washout, and that's what you're looking for, that capitulation. If you see that, you'll often see the VIX spike up to, it could be 50, 60, 70, depending on how we're going. If everybody thinks we're just going to zero, it could spike up to 65, 70. And that is something that we still have not seen. Now, a lot of time I talk about when you're having a brief sell-off, you'll see the VIX jump up above, maybe 30 or something like that, and then it'll come back below 25 relatively quick. And the traders look at that as a sign that probably this little dip or sell-off is probably over. Now, if you look at the market volatility here, we've had kind of a steady climb. This was probably was Friday, 23rd. Maybe it was yesterday, I'm not sure. But anyway, this is kind of a slow climb. This is more what you're going to see on a capitulation. This was pretty much when the war started. You saw this thing jump up. I thought it was higher than 35, but anyway, then we came back down, and then we've seen this thing move slightly higher. That's not the sign that the bottom is in. When you watch this, you're going to look for that capitulation where you see the thing really jump up, maybe 50 or 60 at this stage, and then come back down, start to move back down, and the market will close higher that day. So that's another thing that we want to watch for right in here. Now, one positive last week was the fact that we saw the secondary indexes, which include the Dow Jones Transportation Index, the Philadelphia Semiconductor Index, and the small cap Russell 2000. The transports and semis were still higher. And if you're looking at some of this SMH would be one, some of these the semiconductor are not really selling off. I mean, they're outperforming the broader market. That's because when this thing gets all settled, you're going to see the semiconductors will lead us higher again. As you can see over here, you got this going sideways since the war started. we're in a pretty good uptrend here all the way with semiconductors. And then the war starts and we're going sideways over here, just trading right around the 50-day moving average. I will note yesterday that we rallied right up to the 50-day moving average on the semiconductor index, and then I pulled back from there. So you want to keep an eye on that. Now, today we're up another 1%. I don't have the chart in front of me, but I wouldn't be surprised if we're bucking up against that 50-day moving average again on that. But that is something that you probably want to look at. Now, whether you want to buy individual semi names, the Broadcom and the NVIDIAs and the AMD and all that, you can make a stock watch list and put a bunch of names in there, or you can just go into the SMH and buy this one. You're going to have probably 15 or 20 different semiconductors. So you'll have a bunch and you're not going to get hit by one of them missing on an earnings or something. That's an area that you probably do want to be looking at to buy as this thing starts to settle out. So anyway, finally, on the downside targets that we had put in here for the last couple of weeks, they were all hit and actually exceeded a little bit on Friday. I don't have new downside targets yet. Yesterday kind of messed me up. As you know, Trump said the thing was over, and Iran said it's not over. We're not even talking yet. And so that brought the market off the highs yesterday. And this morning we opened up about 300 points lower. And then they said the government shutdown was going to be settled probably later today. That made the stocks rally again. And that, of course, a lot of that was the transportation stocks, the airlines, they're rallying on that. I don't know if this will hold or not. I don't think there's enough weighting in some of these transportation stocks to keep the broader market up. However, the NASDAQ was still down despite the semiconductor index being up almost 1% today, which is a little strange. So I imagine you'd probably see maybe software stocks selling off again. We also have a little bit trouble today with the market in this private equity stuff again. You had Apollo Global Management talked about they are getting more withdrawals from their private credit fund. And that caused Blackstone and Apollo, Ares Management, some of these to go down another 4 or 5%. So there is underlying problems there that is hurting. And you're also seeing with rates ticking up, you're also seeing the spread in the interest rates narrowing, very narrow now. That's also going to probably weigh a little bit on some of the banking stocks. So as we go right now, all I can say at this stage is you want to be careful. Something I follow on our cycles is the FLDs, with 4 lines of demarcation. And I think probably you're going to need to see the Dow rally above 47,000, and you're going to need the S&P 500 to rally above 6,700 before you can start to say, this is probably something that I want to start to nibble on things over here. But we're not at that point yet, so I would still be cautious. You're going to be whipped around by these headlines. Underlying market breadth last week was negative. We talked about how the NYSE advanced decline line, especially as a leading indicator of market direction, and it's been down for 3 or 4 weeks in a row now. The NASDAQ AD line, which is not quite as important because you have more junk stocks in there, that AD line topped out back in November when the NASDAQ actually hit its last new high. So it's been going down for a while. You also seen expansion in the new 52-week lows. That's for a 3rd consecutive week. And NYSE new lows also expanded, which they've been pretty well behaved. And in fact, this whole sell-off in general has been pretty orderly. It's not where you're seeing these things, people dying to get out and throwing everything away. I think a lot of investors and hedge funds and stuff realize that, like yesterday, any sign of good news, and we could see the market go up 1,000 or 2,000 points. So they don't want to be completely out, and they also don't want to be completely short to knock the market down even further. So it's a little bit funny, but I do think hopefully we'll get a day of capitulation where you can say, okay, I think it looks like that's probably going to be the bottom. Now, as far as the CTI goes, as you see, we've been negative on the market since the first week of March, and the CTI is at -6. We are at the end of our cycle. I mean, it's scheduled to go at least one more week. They can extend a little bit further, or possibly if we would see something happen this week and the market the Dow doesn't take out last week's intraday low, then there's a possibility that we could reset to a bullish posture, but I doubt it. The number you want to watch on the Dow Jones is 45,369. If we go lower than that, that will extend some of the cycles, the A and B cycle, before we reset to a positive CTI. So keep an eye on that. We also are seeing a little bit of investor sentiment has really pulled back. We were almost overly bullish for months. And then now we've had the retail investor saw an increase in the bears for a fifth consecutive week. In fact, as of last week, the AAII saw the retail bears at about 52%. And that's the bearish retail investors have been since May of 2025. And then you had the National Association of Active Investment Managers, NAAIM, the exposure index. It dropped another 7 points to a neutral 60%. And that's the lowest exposure for equities that the hedge funds have had since also May of 2025. So it's really pulled back. I know intraday on Friday, some of the indexes were back to where they were in September. When you get this, and it's not to the point where some of these indicators are saying, just get me out of here, this thing's going to zero. When they get to the point where everybody wants to throw in the towel, that's generally a sign, like when Warren Buffett used to say, when everybody's fearful, I'm buying. When everybody's buying, I'm getting fearful. So we're not at that point yet, but keep an eye on some of these. When you read the weekly market letter, if you see some big jumps or big drops in these things, that could be a sign that they're close to becoming contrarian indicators. And I'll try to mention that in my weekly letter that comes out on Friday after the close. There's not a real lot of economic data to come out. I don't know how much that's going to change. The economy still seems like it's chugging along. It's not great, but it's not going into recession yet. If this stays up $100 oil for maybe 3 months, you probably could go into a recession. We'll keep our eye on that, but not a lot of stuff that's going to change in the market this week. It's going to continue to swing off headlines over the Iran war. I'm lighting up on big moves like yesterday, but I don't want to be short the market. I'm not shorting things either. Some of my longer term positions, I just assume they're going to be down 20% or something like that, but maybe I'll buy more when the market does turn around and starts to move higher, and I can add to some of those positions for long-term investments. But other than that, I'm staying cautious, and I just don't want to get whipped higher and lower by the headlines. You can also see on this homepage today, we had 42 upgrades, 320 downgrades. And that has been a sign when you're seeing this over here on this chart here, the opinion ratio, when you start having more downgrades than upgrades, you're starting to see that the market's starting to correct a little bit. So as you start to see this start to slow down, that's another sign that we could be nearing a bottom. So other than that, that's about all I have, Rachel.
Sounds good. Thanks so much, David. If you have questions for David or anyone else on the MarketEdge team, feel free to reach out to support@marketedge.com or drop a comment if you're watching on YouTube. Also, I don't usually ask this, but if you wouldn't mind giving us a like and subscribe, we'd really appreciate it. If you're interested in technical analysis on over 5,000 stocks and ETFs, give us a try at marketedge.com. Your first 2 weeks are free, and we'll catch you next week. Thanks again, David.